So good evening to all of you guys. I hope you can hear me. Can you please raise your hands to confirm that you can hear me so that we can get started? Can you please raise your hands to confirm that you can hear me? Otherwise, we can't get started. All right, thank you very much. So that confirmation is important. And now we can get started. So we would like to start by thanking you very much for joining us. And we would like to assure you that this is going to be a very insightful session that is going to incite you to more works and give you insight into the concept of costing. From our knowledge as tutors and from my knowledge as a tutor, I have been a tutor for more than 15 years in the module at third level. And I know that a lot of students struggle with the MSc modules at third level. Just this morning, I was talking to one of the students who has 8 attempts already in the modules, MSc modules, and this year is her ninth attempt. All right, so that speaks of the challenge that students have when they have to deal with this module, right? And so to help students, we sometimes offer these free classes that will help you with insights, and we have Telegram groups where you guys can ask questions and we'll be able to guide you through the concepts. And for those who are interested in private tutorials, we do that as well. So we try to make it easy for students. So if you are interested, we can give you the details. You can pay 100 Rand to join the class, and as we go on, you can come up with your own payment plan, right? And you can pay. That is if you are interested in the private tutorials, right? So we're going to do this question from the question bank. Is Doolax question. Right, I think it must be the first one, right? Question 3.1 from the question bank. So what we're going to do, as we always do in our sessions, we're not going to be interested in the answer to say, so this is the answer. We're interested in how to apply principles, all right? So we will go beyond just the required, the immediate required. We will cover the related concepts as well. We will also show you the techniques and the things that you need to be on the lookout for when you go through a question for costing, right? Costing is relatively simple as compared to finance, because finance is quite broad, right? So obviously your first thing when you go through a question paper, you get a question paper, right? Then your first interest must be to, your starting point is go to the required, right? So you're required, in this required, I think this Doolax was a what? A test or assignment question for MSc 3761 or so, around 2021, I think. 2021, yeah. Right, so we're going to focus only on question A, that has to do with determining budgeted selling price per unit, right? And the year given is 2020 financial year. And the next question, the B question, we're going to cover it to calculate the budgeted number of units required to reach a target profit, right? So we're going to cover that as well. And then we will cover the D part, where we have to prepare the actual statement of profit or loss, right? So that is what we're going to cover. And the recording is going to be available afterwards so that you can have a look at it at your own time. All right, so what we're going to do now, we're going to go and read through everything. So that's going to be the first part. On the first part, we're going to go and read through everything, right? And we're going to be showing you the import or the relevance of the information that is given and how you would apply that in answering the question. All right. So that's going to be the first part. We're not going to answer the questions directly. Right. So this is a family. Right. Right. So it's a Do family and the Lax family. So they form a joint venture. So this is more like a family business. Right. And their business is to manufacture and sell containers. Right. And as a student, you would want to think in terms of whether this manufacturing business, because we very much concerned about climate change, the impact of a business on climate or on the environment as well. So we talk of climate and environmental impact. So in your mind, you would want to think in terms of that as well, right? Their products, their manufacturing process. One of the things that is also very important is the year end. So you have the year end being 30 April. Right. So our year is our financial year that we're dealing with is 2020. So it's 30 April 2020. All right. So that means that the year started on the 1st of May 2019. Now this is very important because sometimes you have income or expenses that are affected by the time duration. So you need to always be referring to when the year started and when the year ended. So you need to take note of the year end, the calendar year, the financial year rather, because that is very important. Then you also need to make sure you understand the costing system being used. Right, so as we always say, I hope there's nobody in class who is here, because if you are in class and also you're in here, then it means you actually wasting your time. Right, this is basically for those students who are not in class. So in our classes, we always emphasize, right, the importance of a costing system. Right? So the costing system that was being used is direct costing system, right? And the direct costing system is also referred to as the marginal costing system or the variable costing system. So the thing with this, the substance of a direct costing system is that first of all, you need to determine contribution, right? So that is the costing system whereby you first of all determine contribution, right? And you need to be aware of that. But now they changed to the absorption costing system. Right? The absorption costing system is our normal costing system that we have been using when preparing our financial statements, right? Where we have to determine the gross profit. So you're going to say your sales minus cost of sales gives you gross profit. So that's how you apply the absorption costing system. Whereas in a direct costing system, you're going to say sales minus variable costs gives you contribution. So with these are very, very, very important things. There is no question that you will come across where you don't have to apply one of these costing systems. It's either you apply absorption costing or direct costing. You need to be very familiar with that, right? And also, the application of absorption and direct costing systems will also affect the calculation of some variances. Right. So your examiners are going to tell you to calculate certain sales variances, right? And those are going to be determined, the formula to be used will be determined on the basis of whether you're using absorption costing or direct costing. So you won't be able to get that right if you don't underline the costing system being used. Right. Then, so that was the costing system being used. And remember, this costing system is basically it's also going to affect the valuation of inventory. Right. Then we also have what we refer to as the cost flow assumption. So when we come to the cost flow assumption, we are told here that the entity uses the first in, first out method to value all its inventories. So this is the cost flow assumption. So the cost flow assumption we could also have used with the weighted average method. Right. So with the first in, first out, the general approach is that when valuing inventory, closing inventory, we exclude the opening inventory for the period. Right. If we're using first in, first out, we just value closing inventory on the basis of the current cost of production. Whereas if you use the weighted average method, we're gonna use what do we use? We're gonna use the opening inventory as well, and we get the average for opening inventory as well as current production. Then we get the average cost per unit. So I would like you to write down those things and make sure you do a follow-up to understand, because you can't understand everything in one session, but a session is going to bring some of the things that you need to pay attention to. So I want you to write down those things and make sure you do a follow-up of how FIFO is going to differ from the weighted average method when valuing closing inventory. Right. And we have two products here that are being sold: the interior paint and the exterior paint. Right. Also remember, guys, that we're gonna be taking your questions. All right. We'll be taking your questions later on after the session. So please, if you have any question, can you write it down, and then after we're gonna go through your questions. Right. So this is the process, and this is the process of the manufacturing. Then this is what is added, the secondary ingredients. And we are told that there are no losses that occur in the manufacturing process. This is an important statement because if there are losses, then the required material should take into account the losses. For example, if we know that we need 100 units to be delivered, for example, this is just an example, right? Right, but we know that 4 are going to be lost, then we can't dispatch 100 units, because then 4 units are going to be lost and we'll end up delivering 96. Right? So if there's a loss, then we have to factor that loss, right? So that we want to deliver 100, we include the loss. So that we have to prepare 104, knowing that the other 4 we're going to lose them. Eventually, we're going to end up with 100. Right, so if we want, if the loss is given as a percentage, say we have a percentage loss is 2% loss, and then we need to manufacture 100,000 units, right? So, or we need 100,000 quantity of some material, right? Let's say it's liters or whatever. We need to have 100,000 liters available. But if 2% is going to be lost, then we need to divide this by 98%, so that we end up with I think with more than 100,000, so that when the other 2% gets lost, we are left with the actual quantity we need to use. So whenever you go through a question where there is a loss, remember that you need to have more input than is required for production, so that you cater for the loss. So please do pay attention to these losses. But in this case, we are told that there are no losses that occur in the manufacturing. Right? And then there's a target profit for these guys, right? So the first question wanted us to calculate the budgeted selling prices, right? We are being told here that the manufacturer, this is the budgeted information for 2020 financial year. So when you deal with the first question, remember we're dealing with the budgeted information. So please do pay attention. Sometimes you have actual information for 1 year, like budgeted information for 2024, actual information for 2024. Then you might also be given budgeted information for 2025, the following year. So you need to make sure you're dealing with the correct year and the correct set of financial statements or set of financial information. So we need the budgeted. The first question says the budgeted selling price for 2020. All right. So we're going to focus on the budgeted, and the year is 2020 as well. So the units that we want to manufacture is 6,000 for this guy and 18,000 for that guy. And we intend to sell 5,400. These are the sales units, right? And we intend to sell 16,200 for the other guy. And our budgeted gross profit margin percentage is 30% for both product types. Now that is very important because it's going to help us to calculate the selling prices. And it shows you here that the gross profit margin or percentage. So that refers to the gross profit over what? Over sales. This is the gross profit margin. Margin means divided by sales. Margin means over sales. So when we have gross profit margin, that's gross profit over sales, should be 30%. So if the margin, right, remember it's the gross profit percentage is 30%. In other words, this means that if you have a selling price, 30% of the selling price will be gross profit. Then it automatically means that the cost of sales is going to be 70%, right? Or the cost of production included, the cost of that unit, right? So the cost of the unit is going to be 70%. And then on top of that, you have 30% of the selling price. Right? So when we deal with margin, I want you to underline that. If we are given a gross profit margin or gross profit percentage, it means that we are saying right, 30% of the selling price is made up of, is actually the gross profit. Then it means 70% of the selling price is actually the cost. All right. So which means that if we have the cost, if we can determine the cost, then we know that the cost is 70% of the selling price. So the selling price will be equal to the cost of production over 70%. If we are given the gross profit, and then we know that the gross profit is 30% of the selling price, then the selling price will be gross profit over 30%. Right. I hope that does make sense. If it doesn't, you can write it down and hopefully follow up on another time. So what this question then requires us to do is to determine the cost per unit. Once we determine the cost per unit, then we know that that cost per unit will be the 70% of the selling price. Then the actual selling price will be cost per unit over 70%. So this is a case where we are given the gross profit margin. In some cases we are given the markup on cost, right? So please distinguish between gross profit margin and gross profit markup on cost. So they will always be clear, whether it's markup on cost or markup on sales. So if you are given the markup on, so let me just write this. Sometimes they give you the gross profit margin, right? So, and this is the same thing as the gross profit percentage, and this is the same thing as the, sometimes the wording used is markup. So you have markup on sales, right? So that's the same thing. And sometimes then they give you, so this is just one, which is what we have now. Sometimes they give you the markup on cost, gross profit markup on cost. So basically means that if the gross profit markup on cost is 30%, what this means is you're going to first of all determine your cost, right? Then once you've determined your cost, then you add cost plus 30% of that cost. So that is going to give you your selling price. So your selling price is going to be based on the cost. Then you have a markup on that cost. So if the markup is 30%, for example, then you're going to add 30% of the cost, which is your profit, right? You have your markup on cost, then those two combined is going to give you the selling price. So you need to make sure you understand what is provided, right? Are we provided with the gross profit margin? Are we provided with the gross profit markup on cost? So in this case, we have gross profit margin percentage. Right? So it's on sales, on the selling price. But remember, I said that you guys should write down your questions and ask them at the end, because not everyone would love to wait. Some would love to go immediately after the session is done. So please just write down, then we will be with you. Right. So the first question requires us to determine the cost, the selling price given this markup. So here is the direct material requirements and the related costs. So when I teach in my class, I always say that you need to know the standard quantity that is required per unit. So you need to have a separate calculation where you determine the standard quantity per unit, how much of this material is needed per unit. So you need to determine the standard quantity per unit as one of the steps. And the other step is you need to determine the standard price per quantity, whatever the quantity is. So if the quantity is liters, then it will be per liter. All right. If the quantity is kilograms, then it will be rands per kilogram. If it is meters, then it will be meters per rands per meter. Right. So you need to know those two. And I say that you have your standard quantity or standard price. It might be an actual quantity and an actual price. In a case whereby you are using the where you are preparing the actual information, right? But we're going to demonstrate using the standard quantity and the standard price. So the cost per direct material, 28 rand per liter is the standard price, right? So your price is 28 rand per liter, right? And then you need your standard quantity as in liters per unit. And if you're in class, you remember that we have covered this several times, and it's a core issue in our learning. It's a core concept in our learning, whereby you need to align the standard quantity and the standard price. So your standard price says rands per liter. Then you might need to have your standard quantity as liters per unit, because your price says rands per liter, right? This is your standard price, right? It says rands per liter. Then it would be great if you have your standard quantity as liters, the same liters that you used there, liters per unit, right? That's your standard quantity. So if you look at this, then you're gonna say, okay, the concept here, if I can put it in a very simple way, which everybody would understand. I mean, it's not just for the purposes of the session, but just simple things. If you're gonna be paying 20 rand per liter, every liter 20 rand, every liter 20 rand, and then you need 23 liters. So how much are you going to pay? How much is the cost of solvent and pigment? If you need 23 liters, right, of it, and for each liter you pay 20 rand, 20 rand, 20 rand. So you see that for you to have a full unit, right, because these are requirements per unit. For you to say, I have my unit, now remember the unit, if we looked at the unit here, how much is a unit? I don't know if I jumped that, but I know already that a unit is 25 liters. So I don't know if I jumped the information or because it's a question I know already. But I'm looking for that. Right? So here we have it. Here's the information. Right. It's being sold in units of 25 liters. So each unit is 25 liters. That's per unit, right? A unit is 25 liters. So if we look here, so for each 25 liters, we need 23 liters. And each liter costs 28 rand. So we have the standard price being 28 per liter. And the liters are 23, right? So each liter is 20 rand, 20 rand, 20 rand, right? And then we have 28 multiplied by 23. So if something like 644 per unit of interior. You do the same for exterior, 28 by 19. And I haven't emphasized sufficiently because we cannot cover everything in sufficient detail in one session. Right? That's why we say if you are interested in classes, in sessions, you can come and join us. We're definitely going to transform the way you understand the module. That's what we do all the time. So we will definitely transform how you approach questions and how you play around with information given in a case. So far, I have just said your standard price is going to be multiplied by your standard quantity so that you get the cost per unit. So what this means is your standard quantity is how many liters do you need? You need 23 per unit, right? And how much is the cost per liter is 28. So if you just say your standard price multiplied by your standard quantity, then you need to know the cost per unit of this particular ingredient. Right? And that's what you're going to be doing for all of them. So here it's 20 rand per liter. You multiply that by 23, here by 19. Here it's 35 rand a liter per liter, and you just need 4 liters. Here you don't need to use it. And so you multiply that by 35 by 4. Right? I haven't spoken enough about how to align your standard quantity with the standard price. It's some of the things we can explain to you later on if you like to join class. Then the colorants is 10 rand per liter. So we will need our standard quantity in liters per unit. So it's 2 liters per unit, and it's 2 liters per unit. Then we can multiply 10 by 2 and a 10 by 2. So that's going to be part of the cost. Now remember that this entity uses, what do they use? The absorption costing. So it means that they're going to include all costs of manufacturing. Correct. So all manufacturing costs are going to be included, including the fixed manufacturing overheads. If they used only direct costing, then the fixed manufacturing overheads would be excluded in the cost, in the product cost. Of course, that's just for internal purposes, internal reporting purposes. Right? So that's where we are. Please, if you have any questions, please write them down. Then we come to direct labor. Remember, the guiding concept is that you need your standard price and a standard quantity. That will give you the cost of that component. So if you look at direct labor, we will need the standard quantity per unit. In other words, for direct labor, the quantity is how long do you take to produce 1 unit. That's going to be the standard quantity. So it's going to be hours or minutes per unit, right? And what is this thing called? The standard price. All right, so the standard price is given as standard price per quantity, per number of hours, per number of liters, or whatever it is, per liter or per hour or per meter. But in this case, we already have the cost per unit. It's given to us, so we don't have to worry about that. It's already given, right? It's 21 Rand 50 per unit. So if we write, just gonna put it as it is, as 21 Rand 50 direct labor, right? And I've also emphasized, I haven't, because you are not in my class. I emphasize all the time, and I want to emphasize now that when dealing with this formula where you say standard price multiplied by standard quantity is going to give you your standard cost. Sometimes you are given the standard cost per unit already, like here. You already have the standard cost per unit, 21 Rand 50 per unit of paint, right? So that's 21 Rand 50. And let's say that you are told that the cost of labor is 100 Rand per hour, for example. But you don't have the standard quantity of labor. In other words, how many hours are needed to produce 1 unit. So you would simply say your standard quantity then is going to be equal to your standard cost per unit divided by the standard price. So that will be 21 Rand 50 over 100. So this will give you the quantity of hours required per unit. And you need this ability to manipulate the variables, because that is where students fail. If you see students repeating for a very long time, all right, it is because they cannot make sense of the variables. Because you need to be able to manipulate the variables to extract the information you need from the data that is provided. Right? So we have direct labor and variable manufacturing overheads relate to the mixing of the direct materials by some guy, and the paint mixing plant time is 9 seconds per liter at a cost of 900 Rand per hour. I always tell students that it's very easy to pass costing. It's very easy to pass costing with 100% or a 99.5%. 99.5%. You know, you should be able to do that. It's very easy. You know, this thing is so simple. It's so simple. All right. And I have been teaching my class. You know, what can I say? I can say the steps, the baby steps that you need to have, and it's helping them a lot to make sense of the techniques that is required. So we're gonna look at this here together, right? I want you to follow closely what the examiner is saying, because this is a very simple thing. You need to know the standard price. You need to know the standard quantity, so that you know the cost per unit, right? Because that's what we're looking for. We're looking for the cost of this exterior and the cost of this interior. But we need to know how much do we need. Do we need 10 kilograms? Yes, and each kilogram is gonna cost us 2 Rand. So to have this particular input, we will need 10 kilograms, right? And each kilogram is gonna be 2 Rand. So to make 1 unit, it's gonna cost us 20 kilograms. So that's what we're looking at here. What is the cost of the variable manufacturing overheads per unit? How much is the cost standard price and how much is the quantity. Very simple and straightforward. Very, 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 very simple, right? It's simple. You are given here is 900 rand per hour. I told you this is your standard price. Your standard price is going to be rands per unit of measurement, rands per hour, rands per meter, rands per liter, and so forth. So this is your standard price. And we now look, we need the standard quantity. And we know that the standard price is 900 rand per hour. So it's better for us if we can get our standard quantity in hours per unit. Then we're going to have it because we can simply multiply this and that, right? And then we get the total, right? What do we have here? Okay, so we already have 900. We're done. Now we need to know the standard quantity. In other words, how many hours are needed to produce 1 unit, right? So how many hours? We have 9 seconds per liter. Do you agree with me there? So let's write this very nicely. So as you can see, the standard price is 900 rand per hour. Do you not agree with me? Now we need the standard quantity in hours per unit, right? So a unit, remember I told you one of the things that you must look out for is what's the quantity of a unit. And you will remember that a unit is 25 liters. Not so. So for every liter here, we will spend 9 seconds. Every liter, 9 seconds. Every liter, 9 seconds. What about 25 liters? So we multiply that by 9 to see how many seconds are we going to take to produce something for 25 liters. Every liter, 9 seconds, 9 seconds, 9 seconds, until we're done with 25 liters. So the number of seconds we will have to is the total number of seconds is 25 multiplied by 9. So we're going to have 225 seconds. But we have our standard price as rands per hour. We better have our standard quantity as hours per unit so that we can multiply these two. Because you cannot multiply 900 rands per hour, then you say 900 times 225, because these are seconds and these are hours, right? So we have to align them. So the standard price says per hour. So we are better if we can have hours per unit. But now we don't have hours per unit, we have seconds per unit. 225 seconds per unit. So what I'm going to do is that I'm going to divide this by 60. So I've divided 225 seconds by 60. That converts them to minutes. But I don't need minutes, I need an hour. Then I divide the answer again by 60. Then now I have changed these to hours. Right. So, or if you already know, you can simply say 225 over 3,600. All right, because 3,600 seconds is the equivalent of 1 hour, or 60. We divide something by 60 and by 60 again. It's the same thing as dividing by 3,600. So if you have seconds and you want to convert them to hours, you divide by 3,600. If you have minutes and you want to convert them to hours, you divide by 60. So now we have converted these two from seconds to hours. Why did we do that? Because our standard price is rands per hour, and we better off if our standard quantity is also hours per unit. Then we can just multiply those two. So now we have 900 rands per hour multiplied by hours per unit is 225 over 3,600. These are hours per unit now, right? So I have 900 multiplied by 225 divided by 3,600. So I have something like 56.25 per unit. This is the cost of the variable manufacturing overheads. The guide was just get your standard price, look at your standard quantity, it must be per unit. In this case, you were given 9 seconds per liter, but we don't want it per liter. We want per 25 liters or per unit. And then when we get the quantity per unit, we need to make sure that it agrees with the standard price. Because the standard price says runs per hour. So can we also have the standard quantity as hours per unit? So we can just multiply those two. Because if the units of measurement are misaligned, are different, you can just multiply. Right? They have to be aligned. I hope you like that. I hope you enjoy that. Or even if you don't understand something, one of the things that my students tell me is, well, I didn't understand, but I'm inspired. You know, that's a very important step, because you might not understand something once off, but you can see the light, right? A little bit of flashes of light, right? And you can be inspired. And that's what we want. The inspiration is going to drive you into a rematch with whatever you didn't understand. And that's what we want. Now we come to the fixed manufacturing overheads. What is our trick? What is our technique? What is our framework? Our framework is standard price times standard quantity. So we need to know how much fixed manufacturing overheads are required per unit. Right? Right, we are being told that the company's budgeted fixed manufacturing overheads, FMO, of 3,450 for the year. Right. Pay attention to the time. Sometimes it's per month, sometimes it's per year. Are allocated based on the budgeted paint mixing plant time. See 1.6 above. All right, and now this has to do with the allocation of fixed manufacturing overheads. And for you to be able to allocate your fixed manufacturing overheads, you need this. You need to remember this formula, right? I'm writing everywhere, but so I hope you guys can. Right, you'll be able to make sense because there are writings everywhere. So you need to determine your standard price for the fixed manufacturing overhead, and the standard price. Remember, we said we agreed here that our trick is the standard price times the standard quantity. So we need to determine what is the price of each fixed manufacturing overhead, and we know that the standard price is the predetermined rate. All right, so this is your predetermined rate. All right, or your overhead absorption rate. All right, and so to determine your overhead absorption rate, you need this formula: your budgeted fixed manufacturing overheads. In other words, the total budgeted fixed manufacturing overheads divided by the total budgeted allocation basis. Right. So the allocation basis, we need to determine the allocation basis, and we determine also the total budgeted allocation basis. Right. So for now, we already have the budgeted cost is 3,450, not so. So we already have the denominator as 3,450. Is that the denominator? That's the numerator, I think. Now we need to determine the allocation basis. Is the allocated based on so the basis is the paint mixing plant time, the time. All right. So you remember that if we refer to 1.6, the time required per unit is 225 what? 225 seconds, and we said it's better if we get that into hours. So we divide by 3,600. This figure here, which we haven't simplified, so this figure we haven't simplified here. What is it? Is the hours per unit, right? Because this 225 seconds is per unit, but we just divide by 3,600 to convert it to hours. So this is hours per unit. So each unit is going to take so much, not so. Each unit is going to take so much. So how many units did we budget to produce? Because each unit is going to take so many hours. Each unit, so many, each unit. So we now need to go to the budgeted production to see how many did we budget to produce. 6,000 plus 18,000 units. So total 24,000. Do you agree there? But each unit is going to be taking 225 over 3,600. So we have 24,000 units. So I have the total, because it's based on the budgeted plant mixing time, right? Budgeted paint mixing plant time. Oh, that's long, right? So we need to know how much in total is required. How much is the total required? The total time. Because each unit is going to be taking 225 seconds, right? And we need to produce 24,000 units. So 225 multiplied by 24,000, all right, divided by 3,600. So each unit is gonna each unit, is that correct? Each unit is gonna be taking one. Is it each unit? No, not each unit. The total hours is 1,500 hours. That's the total hours, right? Because we have 24,000 units, and each one is taking 225 over 3,600. So this is the hours per unit, and this is the total units to produce. So the total hours required is 1,500. Right? So the total is 1,500 here. Right? That's the total allocation basis. So now we need to know how much to allocate per hour is 3,450,123 divided by 1,500. So per hour, the standard price per hour is 2,300. So how much are we allocating? We're allocating 2,300 rand per hour, right? Do you agree? So for every hour, this is the overhead absorption rate. This is the standard price. The standard price is rands per hour, rands per liter, right? So this 2,300 rands per hour. And how many hours do we need? Now this is the standard price. We now need the standard quantity. Because our standard price is rands per hour, we better have our standard quantity as hours per unit. And we already have it, right? Hours per unit is 225 over 3,600. This is the standard quantity per unit. This is hours per unit. So now you have your 2,300 as per hour multiplied by hours per unit. Right. So that's 2,300 by 225 divided by 3,600. So it's gonna give you 143, right, 0.75. I am pretty sure that you are confused now. You should be confused. That's why you attended the class. And there's no shortcuts. There's no magic like you come to class, then all of a sudden you start understanding. What the session should do is should give you insights, like I told you earlier, and not just the answer, but the insights. So we hope to give you the insights, and we hope to give you the inspiration to say, but I think I can get that, that conviction, like if I follow that one more time, I'll get it. So don't expect you to just bamba everything. The moment we say it, then you bamba it. Not quite what we expect from students. We expect you to be inspired, to be convinced, to have your internal conviction, like, I think I can follow this. That's the quality we want. And then, if you are in our class or in whoever's class, they should be able to guide you, and then everything should be right. So we have now, we have all the costs that we require, right? The fixed manufacturing overheads, and we included the fixed manufacturing overheads because they are using absorption costing, right? So because they're using absorption costing, we included this fixed manufacturing overhead cost per unit. Then also the packaging is 3 Rand 50 each, not so, right? So that will make you very happy. Then right now we can go to the answer, and to end the answer, I'm not looking for the answer. I just don't want to do the adding up on my own, right? So this is, so I'm just gonna take one. Interior is color rent. Remember we did this calculation. We said 25 by 23, right? And here we said 10 by 2. Remember this we said was given, and this we did calculate, and we said 900 multiplied by 225 over 3, 600, you remember. Then this is given, and this we just calculated now. So the total cost, right, per unit is, for this particular guy, is 889, right? And now we know that this is 889, right? It's 70% of the selling price. Therefore, our selling price is going to be equal to, if you divide both sides by 70%, then you get 889 over 70%. Then that's going to be your selling price based on the information given, that the gross profit margin. And if it was a gross profit markup on cost, then you would have this as your cost. Then you would say cost 889 plus 30% of that cost. Right? Then that will give you the selling price. So you need to pay attention as to what exactly is the formula to use, right? Right. So basically, this is the principles that you have to follow. I'll be happy if this gives you the conviction that you can do it. That's what I'm looking for. I don't expect you to just catch everything immediately, but I expect you to build that conviction that through the instruction we give you, you have that conviction like, this is doable. I think I can do this. Right. Then that's what we want. Right. Then the other guy here was the other question. Remember to write down your questions, right? And then I will take your questions later. The other question says we need to determine the budgeted number of units per product type. So that's going to be your standard what? Break-even questions, your standard cost volume profit analysis. And I think that is really simple, right? So I'm not going to do much emphasis, but what I'm going to do is I'm going to take you through this. Is there anybody in class here? What does this mean? Ignore all the implications of opening and closing inventories. We cover this all the time. Gladys, you just came in time, right? You just came in time. There's a lady called Gladys who just joined here, and she is one of our students. So, Beverly, Gladys, we have been talking about you. We have been waiting for you here. Everybody has been waiting for you. So I just underlined this, if you can hear me. Please don't disappoint me, because I recommended myself as an amazing tutor. So please don't disappoint me. There is this statement here, Gladys, that says, ignore all the implications of opening and closing inventories. So can you explain to everyone what that means? Are you there, Gladys? Can you explain to us, please? Who else is in class here? But I didn't quite check. I wouldn't expect students in class to come. Are you there, Gladys? Can you just give us a quick explanation, please? What does that statement mean to say ignore all the implications of opening and closing inventory? Well, I don't think we can get that today. Right, so this statement here means that you assume, the examiner is saying, assume production, all the units produced are going to be sold all the time, like, or every time when you produce something, you're going to be selling it, right? So when they say ignore the implications of opening and closing inventory, they're saying whatever you produce, you're going to sell it. That's basically what they say. So you don't have to assume there was opening or there will be closing inventory. So what this means is use your production as the amount of sales units. So what this means again is use the production mix as the sales mix. That's what the examiner is saying to you. So we're going to the production mix here. So our production mix is, we need to produce 6,000 and 18,000. So it means that we're going to produce 6,000 and sell 6,000, produce 18,000 and sell 18,000, because there's no opening or closing inventory. That's the import of that particular statement, right? So and the trick that we use in class to get the sales mix is to say the bigger amount divided by the smaller amount, right? Yeah, it's general, so it's 18,000 divided by 6,000. So that is 3/1, and our sales mix is going to be 3:1. Right. That's the trick we use for this guy. Where are we and what do we want? Right, so I was actually reading the question, right? I was reading the question. Right, so that's one of the that's one of that. And then we've been told to assume. Please do pay attention to this. This is extremely important, because your examiners are going to give you additional information inside the question, and they're going to ask you to assume certain things. So what happens is that students are unassuming, right? And then they make a mistake. Or not really that they make a mistake. They don't see it. Because they don't see it, they're going to calculate their own contribution and waste time doing this calculation. But the examiner has given you, like, okay, I want you to use 480 as the contribution, and here I want you to use 530 as the contribution. Right. Now, starting from there, now calculate the budgeted number of units per product type. Right. You guys should know the formula. It's very easy. It says the total fixed costs plus the target profit divided by the weighted contribution. Some of you, depending on where you come from, use weighted contribution margin. All right. Some of you just use the weighted contribution. So in my class, I use the weighted contribution. It's the same thing. It's just an extra leg to get the contribution margin, but doesn't change anything. So remember that we were given the target profit, and we have the fixed costs here. One thing you need to also to pay attention to is that your total fixed costs will be made up of your fixed manufacturing overheads, the fixed manufacturing costs, plus your non-manufacturing costs, normally your fixed admin costs, your fixed selling costs, right? Your fixed selling costs, and so that's your total fixed costs. So anything that is a fixed cost, it doesn't have to be manufacturing, just anything that is a fixed cost. So please don't just put in the fixed manufacturing overhead and forget to look for other non-manufacturing costs. Then you add your target profit, then you divide by the sum of the weighted contribution. So your weighted contribution is you have 480 What am I going to do here? Because I don't want to keep scrolling down. So I will try to just put it in here. So this is 480, right? We are given that, the contribution, right? And this is 530. So which means that for you to determine the break-even required, the break-even number of units, you need to know you first of all need to determine the contribution, and contribution is your selling price minus your variable costs per unit. But in this case, we are being spared. The examiner says, no, don't worry about using that, doing the calculation. I'm just going to give it to you. And then this is the contribution per product, per unit, and the sales mix. Remember, the sales mix is going to be your production mix, because whatever you produce, you're going to sell, right? So I think this is 1, this is 3. Right? Remember to align properly. So if you multiply here, you get 480, and if you multiply there, you get 1590, right? Right, 3 times the contribution multiplied by the sales mix. So I have for this it's 480 multiplied by 1, and the other guy is 530 by 3. So I have 480 plus 530 times 3. So it's 2070. The weighted contribution, sum of the weighted contribution is 2070. So I'm going to say 2070, right? I'm going to say 2070, right? And as the sum of the weighted contribution, and then I get a total here. Then I get the number of batches required, and I round up those number of batches required. So which means that if I have batches, it means for each batch I will have 3 of the other guy and 1 of the other guy, which is the sales mix. So each batch will contain 3 units of 1 and then 1 unit. 3, 1, each batch. So the total number of units you have to multiply by the sales mix. I'll just go to demonstrate here. Right? So your total fixed costs plus target profit divided by the weighted contribution. So this is your total fixed costs, and this will include the non-manufacturing costs, and this is your target profit. This is your sum of the weighted contribution. So the number of batches you round up all the time is 4165. So if you produce 4165 batches, each batch will have 3 of that exit exterior and 1 of the other. So in total, the number of units required for this is that, and for that one is going to be 4165. So I just did a quick summarization of that, because that is not a difficult concept, right? So here we are. So what I'm going to do is that I'm going to quickly demonstrate the principles of an absorption actual statement, right? Not the actual calculations, because the actual calculations we have dealt with the concept, right? So I'm going to focus on the actual principles, right? Now we're looking at the actuals. So let's go to the actuals table. Let's go to the actuals table. Right. So we had we manufactured, the actual is 19,200 in total, right? This was the budget. And I said to you, please do pay attention to the whether it's a budgeted or it's an actual, because we are dealing with an actual statement. We want this actual, right? Right, so I'm going to explain to you the concepts. So the budgeted fixed admin expenses is 3, this and that. Remember we did that, but the actual is that. And now this is the actual sales units, right? Let me just go again, just to understand the question one more time. right? So I'm going to prepare the actual statement for both, right? I was thinking maybe it's just for one product, but then it's for both. Very beautiful and interesting question indeed. Right, remember this question is coming from the question bank, so you will have time to go through the calculations and everything. So I'm going to just focus on the principles here. So the first principle is to get your sales. And it's going to be your quantity sold multiplied by the actual selling price. So your actual quantity times the actual selling price. So let's look for that information. Right, so it's 48 the actual sales times, so 48 times 1200, that's just one, then plus the other guy, we sold 12,240 times 1,350, which is the selling price. So this is going to be the total sales, right? So that should be easy. Now the closing inventory, right? So you see here that the interior piece, the opening inventory units, no, we need the actual, not the budgeted, because we're doing an actual statement. So the actual is what we need, is 400, right? So for interior P, we started with 400, which is the actual, and then we produced more manufacturing units. It's 4,800. So we have 400 opening inventory plus 4,800. So these are all the units that were available for us to sell. So it's 400 plus 4,800. It gives you 5,200. Then at the end of the year, we sold 4080. So out of the 5,200 that we had, right, we sold 4080. So it means that our closing inventory is going to be equal to 1,120 units, right? We do the same for exterior piece. We start with 0 because there was no. So we start at the beginning of the year, we started with a 0, and then we added 14,400. And then we sold 12,240. So remaining at the end of the year is your closing inventory, and that's going to be equal to how many units? That's going to be equal to, from what I get, it's 2,160 units. Right? That is very important. Because we use first in, first out, the cost of this unit is the cost of the closing inventory, or the cost per unit, will be based on the cost per unit will be based on the current cost of production, right? So I want you to remember that. So that's one technique you're gonna use. Then how much did we actually produce is very important. 4,800 and 14,400. Right, so when you do your calculations, when there are more than 2 products, or when there is 2 or more products, please make sure all the time, please make sure, they will not tell you, but as part of your calculation, do this. Say product X, product Y, total. Right, this is going to help you in determining, especially let's say you get something wrong somewhere, you can quickly check where between this and that did you get it wrong. So that's one advantage. Then the second advantage is you can use this very easily to value closing inventory, because closing inventory is a challenge. If you're doing the year module, just go and try a question MSc 3761 for last year. Last year is 2024. There is evaluation of closing inventory where we have 2 products, right? And we have to do right, there are 2 products similar to this one. It's very interesting. So go try that. Right. Remember that these guys changed from direct costing to fixed manufacturing overheads. And because they changed during the current year, right? Right. So which means that they're saying here, notwithstanding the change of the costing system, the opening inventory values as per the management accounts extract does not reflect this change. In this regard, the FMO for the 2019 financial year was determined as 120 per unit. What this means is your opening inventory value has been prepared on the basis of direct costing. Right. Has been prepared on the basis of direct costing. But now we changed to absorption costing. So when we prepare the statements for this year, all amounts, every amount there should reflect absorption costing. We cannot have some amounts measured using some amounts disclosed using direct, then others absorption. Right? Because we're using absorption, everything has to be absorption costing. So we have 400 units, right? The actual units, it's 400. We need to add this fixed manufacturing overhead because last year it was direct, it wasn't included. So we're gonna include the one for the estimate for last year, not the actual. So we will need the estimate for last year and make sure that we add it to the value of opening inventory. So it's gonna be 400 multiplied by 120. Then you add this value to the value of opening inventory. Remember, the value of opening inventory we already have as this is 20 for 2021. We don't like that. We already have it as opening inventory as 284. So you now need to add 400 units, each absorbing 120 rand. Then is it 120 or that fixed manufacturing overhead we have? Please add it because it wasn't included here. This was still direct costing. We have to add the fixed manufacturing overhead because it's now absorption costing. Right, so that must be nice. Right, then what else? What else do we need? Then the actual paint mixing time. All right, but this is very easy then, because I was worried that we're going to do a calculation of all the variable costs, but then the variable manufacturing costs 785 and 815. It's actually given, so it's gonna be, this is variable manufacturing costs, all your direct materials plus your direct labor plus your variable manufacturing overheads. So it's 785 there. And how much did we produce? 4,800, right? And the other guy 815, how much did we produce? 14,400. So actual cost and actual units, right? Then we now need to know how much is the fixed manufacturing overheads to be included in there. Remember that in the actual, in inventory valuation, generally we include, let me just say, let me not say generally, but when we're using absorption costing, you need the predetermined rate. And what was the predetermined rate again? Was it 2,300 rand per hour? Right? If you remember the calculation, I think so. I think it was 2,300 per hour. So we need to know now how many hours did we actually spend in actual production. So it's 9 seconds per liter, but each liter, each unit takes 25, right? So this is the number of seconds per unit, 9 seconds per liter for 25 liters. So this is the number of seconds, the actual seconds per unit. But we produced 4,800 plus 14,400. This is what we produced. Each unit taking so many seconds, right? But now this is the total number of seconds, so I can divide that by 3,600 to get the actual hours. So 9 by 25 by my calculator is not the best. 4,800 plus 14,400, 19,200, and I multiply that by 9 by 25. Then I divide by 3,600. So I get 1,200 hours. Each 2,300 times 1,200 hours. 1,200 multiplied by 2,300. So it's going to be 2,760,000. This is the total. But remember, you need, let me just clarify something here. Because we have two products, we will need 9 by 25 times 4,800 over 3,600, right? For this one only. The hours produced for this, the hours that we actually spend in production for one product, we don't have to combine because we will need to value the each unit separately, right? The closing inventory separately, so we can just have a total, right? So this is the actual manufacturing overheads absorbed 2,760, all right? But this is the actual, all right, absorbed, right? But the actual incurred, so 2,760 is the actual, that's the ones that we have been absorbed or applied. But the actual at the end of the year, looking at the receipts, it's 2,880,123. So if you look at this, we included in production 2.7 instead of 2.8. So what we included in production is less, right, than the actual cost. So this is going to be we absorbed less than we should have. So it's an under absorption. We absorbed less. We absorbed 2.7 instead of 2.8. So we absorbed less. We have to add that extra portion to the cost of production. Right, so I think that's all I needed to demonstrate. Right, then I'm going to demonstrate the rest based on the answer. So, what is this? Right. So the opening inventory, we have shown you how to adjust for that. The variable manufacturing costs is straightforward. The fixed manufacturing overheads, closing inventory. All right. Right. So there's an under allocation or under absorption that must be added. Right. What I want to do, the person who prepared this just gave a shortcut of the answers and not calculations. So, but I don't have a problem with demonstrating. The only problem I have is that I have to find the answers for each calculation. Right, so I'm going to do it quickly, right? So I'm going to start with, I'm going to demonstrate for one product. So I'm going to start with, let me come here. Right, I just want to demonstrate quick. It's not going to take time. Where am I? Right, so I just want to demonstrate something quickly. Right, so let's deal with interior P. I just want to demonstrate how you get the closing inventory. So your opening inventory value is given as 284, right? And we remember that there is a 120 added to the 400. So we have 284,000 plus 120 units, 120 rand times 400. All right. So we have there I have 284, no, 120 multiplied by 400. I get 48 plus 284,123, and then I get my opening inventory for this guy as 332. Right. Remember I said you must do both and then a total. Then I need cost of, I can't get cost of source for one because there is going to be there's going to be over or under absorption, which is applied across all of them. Right? So I can't do that. Then the variable manufacturing costs are given to me as variable manufacturing costs are given to me as what? Right, 785 multiplied by their units that I produced is 4,800. Right, so 785 by 4,800. So I get 3,768. Right. Then fixed manufacturing overheads. Right, I have them as, we did calculate that. That's 2,300 rand per hour. Right, and how many hours did I take to produce 4,800? So it's 4,800 multiplied by 9 multiplied by 25 divided by 3,600. So I took 300 hours to manufacture 4,800. So I'm gonna have 300 multiplied by 2,300. Right, 300 multiplied by 2,300, I get 690. Right, so because I'm using FIFO, I just need this cost here. Right, 690 plus 3,768,123. This is the cost of current production. Right, and now I know that my cost of production current year is, excluding inventory, is 4458, and this 4458 was incurred while producing 4,800 units. So the cost per unit is divided by the 4,800 units. Right, so I'm gonna have 4458 divided by 4,800. So I have something like 928.75, and that 928.75 is the value of the closing inventory per unit. And remember, my closing inventory, what did we say the closing inventory was? What did we say? We said there was 400, then we added 4,800, then we sold 4080, and then we left with 1150. So I have 928.75 multiplied by 1150. All right, so 1150 multiplied by 928.75. So I'm gonna get just the closing inventory for this guy as 10,68063. Then are you gonna do the same for the other guy, for the other product, and then you're gonna combine these two together. Then you get your value of closing inventory. Right, so the valuation of closing inventory is a challenge for most students, but you need to know which system are you using. Are you using FIFO? Are you using weighted average method? If we were using weighted average method, then the cost per unit would be the current production plus the value of opening inventory, what we produced this year plus the number of units in opening inventory. Then we get an average, weighted average. Right, this is just a frame of things. We will for those who will be joining with us, hopefully you guys will be joining because we will help you. Then we're gonna take you through those principles in a much better way. Right, so we have come to the end. Remember, if you would like to join classes, you can join. We hope you do. You can join for 100 rand, and then you can give us your payment plan. How do you intend to structure your payment over time? Then we can talk to you, and then we agree, and then we will be able to help you through. Right, so thank you very much for joining. So here is the number that you can WhatsApp if you would like to join our Telegram groups, because we do engage students on Telegram only. Now,